Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to another episode of our InvesTips series. As digital currencies continue to capture global interest, today's episode is about breaking it all down and helping you figure out if it actually fits into your financial journey. Joining me today's podcast is my colleague Vipul Kumar, a seasoned financial service and fintech leader and global head of FX derivatives and digital assets at Standard Chartered. With over 2 decades of experience across crypto, tokenization, stablecoins, and CBDCs, he's shaping the bank's future-ready digital asset strategy. Thank you, Vipul.
Thank you, Steve. That was a very generous introduction for me. And yes, I think it's a very timely conversation that we are having. So yes, digital assets and particularly cryptocurrencies have found a very strong footing in the recent past, last 4 to 5 years, where some people are even touting them as alternatives to commodities like gold, pressure. They've found a place in investors' portfolios.
Yeah, so I guess most of our listeners have probably heard about Bitcoin and Ethereum, the two cryptocurrencies that probably dominate most of the headlines. But at its core, cryptocurrency is simply digital money built on blockchain networks. And while news highlights the massive ups and downs, there's a lot more to understand before investing in them. So could you start by giving us an overview of cryptocurrencies?
So that's right, Steve. I think what has happened is that a lot of volume has come, a lot of financial institution interest has come into this play. A lot of regulators are looking at it keenly. We are hitting massive volumes, right? So trading volumes of close to 100 billion a day, market caps in Bitcoin, Ethereum, 1.6 trillion. That's huge by any standard. But what is cryptocurrency? So cryptocurrency is nothing new, right? So if you ask any computer science graduate, they have been looking at these set of data structures or databases for a long time. What it is essentially is just a distributed ledger technology that works on a blockchain. Now, for somebody, these might already be jargons, but they are nothing but ways of organizing our data and kind of building mechanisms where we make sure that the data that is sitting in these databases is accurate. Everybody wants and agrees to that, and then finally attaching a value to that data, right? So it becomes therefore a means of transferring value between two people. Notably, the first transaction that happened was for 10,000 Bitcoin in exchange of 2 pizzas in 2010, right? So that was when people actually realized that if everybody agrees that there is value attached to a particular token or a coin, then we can transfer values in between them.
Okay, so I guess even after the declines we've seen in cryptocurrencies, they're very expensive pizzas this day and age, right? But so obviously investing in trading in crypto requires an understanding of new terms and protocols. So could you walk us through some of the nuances?
So yes, I think let's not going into too much of details and too many of intricacies. Let's start and take, I will be making references mostly to Bitcoin because that's what most people are aware of. So how it starts with is by mining. Now, what you do is that the people or the person whom we don't know who he is, who define how Bitcoin blockchain works, it defines a set of complex algorithms that need to be solved. Complex mathematical problems need to be solved. The more you solve, the more you mine. And by mining, essentially, Bitcoins do get generated. So that was essentially how mining was defined. It is extremely power consuming. And that's why you would hear a lot of environmentalists who don't like Bitcoin. But that was essentially what it was. Now, mining generates tokens or Bitcoins or the digital currencies. Now, they need to be stored somewhere. Where do you store them? You store them into wallets. They could be hot wallets or cold wallets. Hot wallets are wallets which are always connected to an internet. You can take value out of it, transfer coins out of them, or transfer in coins, right? So they belong to a certain person. Cold wallets, on the other hand, are offline. They're not always connected to the network. They sit in specialized hardware. You can think of them as special USB sticks or of sorts, highly protected ones. There are companies who do these, like Ledger and Trezor, and you could keep them with you at any given point in time. Where do you exchange these cryptocurrencies? Like stocks trade on exchanges, cryptocurrencies trade on exchanges, right? So you would have heard of common names. I mean, there are many of them. You just need to Google them, and you'll find Bitcoin and Ethereum trading on exchanges. Now, what they do, just like a stock exchange, they match buyers and sellers. At a certain value, there are people who are willing to buy, and at a certain value, there are people willing to sell. So that's just an exchange. Now, that's a centralized exchange because there is one company or one exchange that's controlling the flow. Then there are decentralized exchanges. In a decentralized exchanges, you're essentially not transferring the value, but you are essentially giving access to your holdings, and there are people who you could directly transact with on a decentralized exchange. And that's where a lot of new activity is going on. The world of staking and yield farming is actually taking shape there. And it's becoming a lot more interesting for people who are looking to get value out of their existing holdings.
Okay, so that's a very good starting point. I guess one of the concerns I think that a lot of people have is the legal status and regulatory oversight. Can you give some sort of context as to where we are there and how that's progressing?
So, digital assets have been looked at a very strong interest from the very past, both by investors and the regulators. So these were essentially designed for transfer of value, and a biggest motive behind these were privacy, not being able to know where the transactions are originating from, and that's kind of muddled the value or the value chain that they were supposed to create in the first place. But over time, it has become a lot more transparent. There are protocols that are established. There are technologies that are established that can trace where these transactions are originating from. But the regulators are still very concerned because they tend to be very speculative in nature. They are very volatile. There are still technological issues that are muddling the waters here because Bitcoin and Ethereum do tend to get stolen from some of these exchanges, and we have seen huge cases like this, Mt. Gox, etc., where people have lost tremendous amount of money in there. So regulators are trying to protect it, but just like we are learning and putting these new investment asset class into its right place, regulators are also doing so. They want to protect the investors. There are muddled or gray areas in the regulations. Something that protects you in one jurisdiction may not protect you in the other jurisdiction. So you have to be very careful when you're investing or when you're putting large sums of money on where or what protection do you have.
Okay, so maybe let's move on to some of the investment options available. Can you just give us a quick outline of those potential options?
So I think this is where it gets very interesting when we are talking about investment options, because that's where we in the wealth space are looking at actively. So when we look at it from a traditional finance space, the easiest way for any investor is to get through traditional asset classes like mutual funds, which invest into Bitcoin, Ethereum, or some of these companies that invest into them or work in them. Or we could look at ETFs. As you would know, IBIT, the iShares Bitcoin fund, has become one of the biggest success stories of all times, right? So there are enough options where you can play in the existing sphere of things. there are investment houses who are doing even structured products on them now. So that's super interesting. Moving on, if you want to go and do a pure play into the digital asset space, one could start by buying Bitcoin and Ethereum directly through some of the regulated exchanges. I would highly advise so, because they tend to put in the proper safeguards. Look at buying some of the more traded or liquid assets like Bitcoin, Ethereum. Look at the right asset allocation on where does it fit into in your overall portfolio. So that's where it kind of is at the moment in the traditional asset. If you want to go into the natively crypto space, once you can look into staking into yield farming. When you stake your holdings, you put them, you give ownership to a particular person, or the person who is trading on your behalf. You get gas fees in return. You increase your holdings. You get smart contracts back. Those are also stores of value, which increases your portfolio value of your cryptocurrencies. And then if you want to further kind of look into it, there are more riskier ways of investing, like ICOs, initial coin offerings. Think of them of like IPOs in the world of stocks. And then there are more ways of investing, like private equity funds and venture capitalists that are going into the specialist areas where you really need to know what you're doing and you're investing in the right places.
Okay, so that's very helpful. I guess it's important to remember that cryptocurrencies aren't for everybody, though. Maybe if you can, obviously there's the volatility of the underlyings, right? So Bitcoin's volatility nearly 4 times that of equities, which is both positive when markets are going up, but also negative when markets are coming down. But can you give us a sense of, just quickly, some of the other key risks that investors should be aware of and how they might be able to manage them?
So I think when you're investing into direct cryptos, one thing you have to be really certain is how confident or how comfortable are you in dealing with technology. If you're not, then there are ways of doing it. You still can participate using the traditional financial methods and leave it to the experts on how they handle the digital assets. If you are ready to experiment, you can start with a small amount and start building your knowledge by opening your digital wallets, connecting them to exchanges, and start investing there. There are always middle grounds. There are financial institutions who are giving you access in a very regulated and a safe space, even in direct digital asset investments. So look at those. Now, you have to be very careful that despite the best of efforts, there is always a risk of you're losing your digital assets, because there are always bad actors out there who are trying to exploit vulnerabilities in these exchanges or in these storage assets, right? You have to be very careful of how you are safekeeping your assets. Put your money into reliable wallets. If you are putting them into physical wallets, make sure you remember on how to retrieve them back. There have been cases, you would have known a special case of Mr. James Howell, who lost about 8,000 BTC, which are sitting somewhere in a landfill. There is a Hollywood movie coming out of it. There is also a case where about 7,000 Bitcoins were lost because that person, Mr. Stephen Thomas, a German programmer, just couldn't figure out how to retrieve them back. So those are all the nuances of digital. There are lots of nuances. So make sure what fits your personality, your risk profile, your familiarity with technology.
Yeah, I must admit, I'm forever getting my passwords, so it's probably an important input into any decision making I make on how to invest in crypto. Okay, so maybe just finally, before we wrap up, obviously this is a quickly evolving space, so any sense of the trends that are likely to shape the future?
In the space of digital assets, I think what is going to happen is that the tokenization would take center stage, right? So we will see a lot of real world assets which had the frictions of not being able to settle immediately will get tokenized. We will have stable coins coming into the picture. real-time settlements would be a reality. There will be secondary markets that would be that would eventually come into picture, where people could trade amongst themselves on assets that were not known to trade that way. So I think that's something very, very exciting for us in the space of wealth. What is also picking up in the DeFi space is that there are several new tokens coming up which could potentially be used for staking and yield farming, and you can get access to a lot more value. You can make your money work harder using some of those. The central banks are looking at it as well, right? So CBDCs are one of those things that are evolving. The new tokens, new jurisdictions are coming and are trying to revolutionize how the money would flow. Then there are meme coins, right? So the NFTs of the world, which initially just started as experiments, more of internet humor, but they're getting a lot of traction as we are developing. So that's another space that we should look at. Green cryptos, right? So they are looking at option on how do we reduce the energy consumption a lot more relevant in today's day and time, and make it something a lot more environment friendly. So that's another space that's picking up, and let's see which are the major successes that come out of in this space.
Okay, well, covered a lot of ground. Thanks a lot, Vipul. I guess in summary, over the next few years, the regulatory framework for digital assets is likely to become more structured and also standardized. Hopefully, this will bring not only better clarity, but also strengthen consumer and investor confidence. With that, we've come to the end of today's episode. Vipul and I would like to thank our listeners for joining us today. If you'd like to know more about cryptocurrencies, please visit the link in the podcast description, and I will look forward to speaking to you again soon. Until then, please take care.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.